Now, there's no doubt that what we are experiencing today is unprecedented in real estate and mortgage lending. My name is Perry Fernandez, certified mortgage planning specialist and president broker of the FernandezGroup.com. The purpose of this is to give you a brief overview of what is taking place within mortgage lending at this time and to offer you insights that you can share with both your sellers and buyers. This information will allow you not only to profit in today's market, but it will help you advise your clients so that they can make educated decisions about buying and selling property. Now, look at this picture. It looks rather ominous, doesn't it? And while it certainly seems like it's going to be a bad day here, anyone who's been through a hurricane knows that there's a world of difference between a Category 1 bad day and a Category 5 bad day. And based on this image alone, we can't really say for sure what we're dealing with. To adequately prepare for this storm, we need more information, don't we? What I'm going to do for you today is similar to what a pilot of a Hurricane Hunter airplane does. I'm going to take you right into the eye of this hurricane so that you can prepare for the kind of storm that's about to come ashore. And from what I can tell, the storm we are about to be hit with is major, even catastrophic. The mortgage meltdown of 2007 is one of those storms. If you were to try and compare the economic damage of this financial storm to that of the storm in this picture, don't even try. In the past few weeks alone, over $2 trillion was lost in global markets. And I don't even think we are anywhere near the worst of it yet. And to add salt to the wound, we are seeing signs that what's taking place here in the United States is starting to infect other countries as well. Within the global economy, not only are other countries dealing with their own subprime woes, other financial companies in these countries have invested in our mortgage-backed securities as well. Now, to get an idea of what is it that brought us here, we have to wrap our arms around what's happened. We have to understand the key determining factors. As with anything this major, there wasn't just one thing that brought this situation to light. No, quite the contrary. There were a number of factors that once aligned produced the laser-like heat that ignited and culminated in the meltdown we have today. First of all, we have what is known as subprime and Alt-A lending. Subprime lending is for people who would like to get a mortgage but haven't done a good job of paying their bills. However, as we're in the days when tracking one's FICO score has become a hobby for some, low scores, even in conjunction with no late pays, can force someone into a subprime mortgage. Now, other factors mandating the necessity of a subprime loan could be little to no down payment, the inability to validate income with tax returns, or the inability to source funds for down payment, or it could just be a combination of all the items mentioned here. Now, Alt-A lending is a lot like subprime lending, except that the borrower will predominantly have good credit. With Alt-A loans, borrowers are unable or unwilling to provide documentation for income and assets. These types of loans are commonly referred to as stated or reduced documentation type loans, or the infamous no-doc or no documentation required loan. All told, including some A-paper type loans in which little to no docs were required, these loan types accounted for anywhere between 40% to 70% of the mortgage business in the last few years. Folks, these accounted for a lot of the loans that were getting done. During the time of the real estate boom, rampant appreciation was seen in the housing market. Investors clamoring for ever-high returns turned to the real estate market and credit markets to take advantage of the boom. This insatiable appetite for new profits led to some pretty wild and loose underwriting guidelines. Now, to give you an idea of how loose things had become, we were able to provide someone with 100% financing for a $685,000 purchase. This person was recently self-employed, had 2 foreclosures, and a bankruptcy within 2 years, all on stated income and stated assets. I don't think you personally would have extended money to this person, but the financial markets were willing to. The person was granted a mortgage based on perfection within the markets, both housing and investment. Today, this borrower would not be granted anything even remotely close. If this person were to slip on a banana peel, do you think he might miss a mortgage payment or lose his house? In short, yes. Now, I can't tell you whether or not the individual in question is still paying his mortgage on time, but others clearly were not. Consumers started showing problems in the third and fourth quarters of last year, and mortgage delinquency started to mount. As such, bond investors started pulling back and companies started to fail. We started to see weakness in the mortgage market last December when the first of several large companies was set to take a fall. Own It Mortgage, a subprime company that was set to close over $20 billion in loans in 2007, was hit with the lack of desire by investors to buy the loans they had funded. Unable to fund the loans themselves, Own It was forced to close their doors, becoming one of the first 10 companies to go down the tubes and be featured on the Mortgage Implodes website, which now lists 114 companies that have gone away. Let's take a brief look into the world of mortgages. Few mortgages are held by the bank or the investor that funds them. Over the past 10 to 15 years, the securities markets have grown markedly as the appetite for higher yield products has grown immeasurably. With this appetite grew a desire for riskier loans that companies packaged and sold in pools known as mortgage-backed securities. Mortgage-backed securities are sold on the open market and are traded much like any other bond, with the expectation that people with mortgages will pay monthly on their obligations, netting an expected yield for the end investor. What happens is that a company may package a group of 100 million in loans and sell them on the open market for anywhere from 100 to 101 million.